The beauty of property investing is it's an illiquid asset. It means it doesn't exchange hands regularly on a regular basis, such as shares and crypto.
He is the best data mind, bar none, in our entire 20,000, 50,000, 100,000 property industry.
What is the primary domain? Is it cash flow and capital growth?
What that tells me is that rental stock is becoming more and more scarce, which means rents are going to keep increasing.
Today, we have the most exciting episode I have ever produced on Australian Property Talk. It is with my great honor that I am welcoming Matt from HtAG onto our podcast. For those that do not know, HtAG is the data software of our industry, and Matt is the creator of it. He is the best data mind, bar none, in our entire 20,000, 50,000, 100,000 property industry. And I have him here on this podcast. It is a humbling moment for this podcast. How are you, Matt?
Good, man. Really, thanks for the introduction. That's really cool. I appreciate it. Now, thanks for inviting me, by the way, as well. I'm really excited to join you guys.
I absolutely mean it. I've got Adi here too.
I was expecting the.
Is there an intro? Is there an intro for Adi as well?
Nah, I was expecting.
I really appreciate the intro, man.
Yeah, that's very funny.
But seriously, if I can just lean into that, yes. I obviously being a buyer's agent, data is everything in terms of how I lay my decisions for my clients, how I educate them. When I started my own investing journey, I was looking at magazines, vacancy rates.
Yeah, me too.
It was a different world, right? 10 years ago, it was a very different world. 5 years ago, things started getting better. And then something like HtAG comes along, higher than average growth, and you start seeing some of the work that goes on behind the scene. I've been very fortunate to become friends with Matt over the last, little while. Oh. I've got Alex, who's a friend of mine as well. I know he's your co-founder.
Yeah, that's right.
He's the real brains behind it.
He's the real brains. So I'm just like a small one.
Matt's the pretty face. Hey, Alex. So I've seen the changes that have happened just in the last 6 months, right?
Yeah.
Life is easier. You're sort of democratizing education, and you love using that term.
Yeah.
Sure. And honestly, man, I know I'm friends with you, but just to be able to do this in this forum is a genuine
man.
honor.
I don't know what to say, really. I'm
say
an emotional guy. I'm going to start getting a few tears. Thank you. I appreciate it, really.
Awesome.
And your friendship has been, it's changed me as an individual as well, man.
Amazing.
Awesome. Let's get into it. I want to pick the greatest mind in our industry. I want to pick his brains. I want him to answer the very question that we have been having a crack at. So I'm going to give you a brief, or Adi's going to give you a brief of perhaps the most common investor that we hear and see in both of our businesses, Flint Invest and Elia, the most common investor and something that we see all the time. So this investor wants to buy under $600,000, is open to buying nationally, is looking for a good balance between cash flow and growth, and wants a good 3-year or 5-year return in that sort of time frame period. They're okay not buying in, the most obvious hotspots that are just killing it. Like there's so much obvious attention on those markets that everyone largely knows about them. We've talked about it at length. But looking at a 5-year return rate, that's really, really positive. I want us to go through 3 suburbs or 3 areas that you may have in mind. And then in these discussions, I want to go through why. And then let's get through the richness of it. That was just some high-level frameworks to help us kind of work out what the parameters are here.
Absolutely. Before we dive in, there's a couple of things. Now, as soon as I hear a brief like that, so let me just rephrase or reiterate. Under 600K, it will be a long-term investment time horizon. They want to make a return within 3 to 5 years, and I'm assuming to buy another property. And you mentioned that they want a balance between capital growth and cash flow.
Yes.
Now, what we need to understand is that the relationship between capital growth and cash flow is it's an inverse relationship in the sense that the more cash flow we see, the less capital growth we see, and vice versa. So if we want to extract equity, if we want to generate a certain amount of equity, and I'm assuming about 30% within the 3 years, let's say if it's 3 years, 30% in 3 years, that will be 10% average annually, not accounting for compounding, but that's already a hotspot for 3 years. So it's we have to understand that as soon as you're allowing for cash flow, we have to determine which domain takes precedence. Why? Because if we're going to equalize both of the domains, we're going to actually lower our long-term averages and actually the ability to extract equity, because in 1 year, the cash flow will pool, in another year will capital growth, and essentially you're averaging the returns out. So I always suggest to everyone to really think about their financial circumstance in terms of the shortfall that they need to cover, and then decide later on what is the primary domain. Is it cash flow and capital growth? Now, you can have both accounted for, but it's always better, and you can have a balanced strategy, but then you have to reconsider the fact whether you're going to be able to extract equity in 3 years.
Yes.
So these are the things that people need to understand before they sort of deep dive. If you want to extract equity in 3 years, I would always assume that your primary domain is capital growth, and therefore the metrics that are associated with capital growth will take precedence when you layer the data and try to find the right suburb. So
love that.
That's because you need to define your own narrative, because that narrative, this is what usually is missing, I would say, in the industry, is that people approach investment from the suburb itself, and there is a narrative that precedes that and a larger narrative that drives everything else. I mean, in the instance, okay, why do they want to extract equity in the first 3 years? Do they have the serviceability in the 3 years? And you would know this.
Yes.
Is it because they're trying to get to a goal of 100K passive income, 150K passive income? So you create a goal, you deconstruct it to the initial purchase, which will be the brief for that initial purchase, and then that drives the research process.
Exactly.
And that needs to align with your, obviously.
So if I crystallize a little bit, let's say we've done a little bit of that work, and we've worked out this particular person is looking for that framework in time for that equity extraction to continue to grow their portfolio, but they've come back to us, they've run that cash flow analysis, and we've done it together, and we've picked a 5% yield figure. So when we say cash flow...
Gross or net?
Gross. So we're not picking a number that rules out most markets. I mean, it probably does, but we're not picking a number that is like, I can't find anything now. It's not 8%. Now I've got to operate in certain, types of markets individually. 5%, you can access a lot of markets at that sort of yield level. You're probably ruling out lots of Melbourne, you're ruling out a lot of the capitals in this current framework, but it's not impossible to go and find a 5% yield. You can go into different markets. Now, if those are the frameworks that we're looking at, where are we looking? What do you think?
Let's try. I'll use the platform now.
He's using HtAG, man. He's using HtAG in front of me.
I can't speak on the top of my head. So essentially, we have predefined filters and strategies. Set 600K equity extraction time frame 3 years. So what I'm doing is I'm clicking on that strategy to see what we get.
This is a live demonstration. This is the one.
Now I usually enable the bedroom filter to cast a wider net so we can get more options. So we now have 6 entries here, but that's essentially 3 options. You have Emerald, Edmonton, Newtown, Queensland, and Port Lincoln, SA. Now, this is not accounting for yield. This is just accounting for your ability to extract equity in the next 3 years. So what you will see, and that's why I wanted to actually show you in real life, what you will see is that I can most probably, out of those, we have Edmonton 5.21% gross yield, Emerald 5.12%, Emerald 3 bedroom 6.14, and then Newtown has 4% yield, Port Lincoln has 4% yield. So out of these 1, 2, 3, 4, you're actually left with 2. Now, and this is because you're left with 2, the fact that you're actually left with 2 doesn't mean that is a bad thing, but you have to consider the notion of opportunity cost at this stage. So, and what I mean by that, opportunity cost for the listeners is the cost of investing in an inferior location, because the negative return or lack of return compounds over time in the same way that the positive return compounds. Nice. So if you're increasing opportunity cost by investing in a certain area, instead of taking you 10 years to realize your goal, it might take you 15 or 20. So it's exponential. So that's why, if you obviously, not because of the wrong purchase, but every subsequent wrong purchase where you don't get exactly what you want, it actually prolongs the time frame or timeline it takes you to invest to realize your goals. So now we have 2 areas. Now these areas are not bad, and I particularly like Emerald and Edmonton for my investment strategy and my brief, and I'll explain what that is. But the question that I would ask a client at this stage is, how fast are you with yield?
Open-minded.
Because you can manufacture yield with a higher deposit.
Yes.
Yes. You can manufacture yield with a higher deposit, put a bit of a higher deposit, etc., and you can, essentially get more. And in that instance, you can actually focus on the areas that provide you with better capital growth opportunities, which will get you to your goal sooner, permitting that you have serviceability down the track.
Yes.
Now, Emerald and Edmonton are good examples, by the way, and they're good areas. One is in Cairns, one is regional Queensland. It would be in Emerald LGA as well, would it?
Yeah.
Yeah, that's right. They are great examples. Now, the reason why we settled on those suburbs, so I always speak about data in terms of layering, but we need to, and I approach it from a macro and then a micro perspective. Macro perspective, it's not as in macroeconomics. From macro perspective is, okay, what are the indicators that need to be there for every across every brief? So essentially, what are the indicators that I don't need to think about? They always need to be there. The first thing that I always consider is data accuracy. The reason why you need to have data accuracy is because, and data accuracy is essentially linked to volume of sales. When it comes to data, essentially, in order for you to extrapolate a discernible pattern, you need to have higher volumes of sales, so you can, from those sales, extrapolate other metrics such as days on market and whatever other you're creating and actually looking at. So volume is very important. Now, when you have volume, you can, from that volume, extrapolate a pattern, which can be transmuted into some kind of a trend in days on market or other metrics. And when you have a fixed trend, the beauty of property investing is it's an illiquid asset. It means it doesn't exchange hands regularly on a regular basis, such as shares and crypto, which means when you have a trend that lasts 5, 6, 7 years, you can infer that it will continue doing so, that trend, depending on its nosedive or the steepness of reduction, etc., will continue doing so in the next 3, 4, 5 years, depending on the length. Now, to put that in perspective, so I'm not too abstract, if you have, and I'll come to, I'm a little bit digressing, but it's providing more information. So when you have higher volumes of data, you can extrapolate a discernible trend. And if you have a trend in days on market that is nosediving for the last 4 years, you can infer that for the next 2 or 3 years minimum, that trend will not reverse to an equilibrium. It will continue nosediving. So you can predict what is going to happen in the future. And this is how we come to that point of equity extraction in 3 years. So I need to know how the market is going to behave in the next 3 years, so I can be able to extract equity in the next 3 years, which means that I need to have a supply scarcity and an increasing demand either now, or it will definitely happen in the next 3 years, which will give me that substantial compounded growth, 30% that I can extract.
Yes.
So data accuracy is very important, and especially if you're investing long term, the more you go into the future, the more uncertainty you bring upon yourself, because you don't know what's going to happen tomorrow, let alone 10 years into the future.
Yes.
So when you're making a decision from a data set, make sure the data set has substantial volume. That's what I always say.
Awesome. Can I add one more thing? Just for
go for it. Yeah.
So Matt has done the fundamentals here of how he's determining this is based on working through demand trends and supply trends as well. Price growth happens in an environment where demand is outstripping supply, and that is going to be driving that price growth. He's talked about using trends in that data analysis to measure how demand is going to perform over a period of time, and using the data that he's got access to concisely through his software, HtAG, to assess that demand and also supply. And by doing so, you can now balance out a modeled sort of equation of where demand will outstrip supply over a number of years based on that trend analysis, using sales volume as the underpinning sort of data sets there.
Correct, from each extrapolating the metrics, that's right, yeah.
Extrapolating the volume of sales that are there, that are going through, feeding the data. And that demand outstripping supply, basic economics curves, is where that price increase occurs.
Absolutely.
Can I add another layer?
Yeah, absolutely.
I want to touch on the whole yield thing just for a second, yeah? So one of the things that I love about HtAG is your ability to sort of assign priority to certain metrics. Now, we talked about a disparity of 1%, I think, between Emerald and Port Lincoln, for example. Mm-hmm. There's 5% and 4%, right?
In yield, that's right.
In yield,
correct.
Right? Yeah. So there was a 1% discrepancy. So on the surface, you're going to be like, oh, well, I'm going to be 1% worse off. This sucks.
Yeah.
But I'm looking at Emerald right now, and I can look at Port Lincoln as well. The other layering that you can do as part of your thesis, and it's not just such a point in time thing, is your vacancy rates are dropping off a cliff, right? What that tells me is that rental stock is becoming more and more scarce, which means rents are going to keep increasing. So if you're 4%, if it looks at 4% right now, you are buying it in such a location that it's not going to be 4% very long. So it's that if it's important to you, you don't necessarily have to filter it as I need 5% today. You can filter it as, hey, I just need a dropping vacancy rate that's been happening for the last 4 years, and it's going to lead me to the same outcome in the year anyway.
Yeah, so you mentioned a few very important things. Now, first one is, and the most crucial one is, we need to determine. I always say data is a representation of behavior.
Yes.
So, what does a reducing trend in vacancy rate imply? Yes. And I always force people to think about it. Think about every metric of what that means. So, reducing vacancy rate means there's less and less rental property available on the market, which inadvertently intensifies the demand for rental property. When demand intensifies, i.e., people want to get rentals, however, there's less and less rentals on the market, which means that it becomes the owner of the property can increase rents. When rents increase, yields increase. So you're right. So essentially, this is why layering is important. You can look at a metric from a certain point in time, such as this month, and say vacancy rate is 4%, but that gives you 10% of the overall picture. When you look at the trend, you can actually understand, okay, I'll put a higher deposit now, but vacancy rates are reducing, which means my rents will increase in the future, which means that, essentially I'm not going to have too much of a shortfall to begin with. So, yeah, that's I was going to get to that layering and why layering is important.
I wanted to steal the thunder from
No, absolutely. And when it comes to going back to supply and demand, so just think about it in these terms. I mean, when I started off, and I do encourage everyone to read widely. I always say that. A lot of the things that I learned throughout the years wasn't primarily through investing in property and buying property. It was also understanding economics, understanding share markets, understanding what supply and demand actually is. And then I reduced it to cupcakes. I don't know why I picked the cupcakes example, but I say, okay, if I'm a baker and I bake cupcakes, and there's 10 people wanting to buy my cupcake and I got only one, I'm going to increase the price of the cupcake. It is the same with property. And this is what I say to people, property investing is actually very, very simple. Yeah. Especially because we got trend analysis and because it's illiquid. I mean, and this is what I mean about trend reversals. Now, you can trade shares on an intraday sort of time frame within a day and it's very volatile. Shares are very volatile and crypto is very volatile depending on how much you zoom in. With property, it takes a long time to exchange hands because of the legislative measures and whatever, the sales and acquisition costs and all of that other stuff. And because people hold on to the property to actually generate wealth. So for you to see a reversal in some kind of a trend, in some kind of a pattern within a certain market, it takes years. And if you know that price growth is based on reducing supply and increasing demand, that's essentially all you need to know. It's very simple. So yeah, absolutely. So that will be the second layer. The first layer is let's account for all of the things that we must have. The second thing is risk, and I usually account for a risk because of the volatility aspect. Usually, and the way we classify risk at HtAG is, what risk in my view is anything that will stop me from realizing my goals. And my goals can be cash flow on capital growth. So what's out there that can actually hinder my ability to actually realize that? And you have economic risk, environmental risk. Economic risk is separated in two little buckets or domains. It will be industry diversification index and mining and agriculture dominance index. And why is this important? Again, let's reduce it to behavior. Let's say I'm investing in a coal mine town and China imposes tariffs or we can't export coal, which means that organization needs to start reducing its workforce, which means that the reduction in workforce impacts on the purchasing ability of those residents, which means that essentially price will not grow because nobody's buying property. And a lot of people have the tendency to include macroeconomic elements but they don't consider the time lag or nuances on what they represent. And let me explain what I mean. I had a lot of requests for people, why don't you include employment figures into HtAG? And I said, because they don't matter. And let me explain. It's a bit of a... Newman in WA has one of the highest employment rates in Western Australia and one of the highest medium incomes in Western Australia, and yet its property has decreased by minus 50% in a decade. So because it's tied to a single industry town, mining workers actually earn a lot of money. When they're employed, the entire town is employed. But because we don't look at the time frame and how macroeconomic changes might affect that mining town, we don't consider the actual volatility that results from that. Yeah. So industry centralization is the one thing that I consider across all briefs. Mining and agricultural dominance. Now, negative environmental effects. Why negative environmental effects? I'll talk about ranges later, but negative environmental effects are flooding and bushfires, essentially. So flooding if you're exposed to a town that is prone to major flooding, you're actually increasing your holding cost. Yeah, because you need to repair your house all the time. Again, reduce it always to behavior. If I'm increasing the holding cost, there's one cohort that I'm disadvantaging, and that's the investor cohort. And now, for me to actually see above average price growth in a certain suburb, I need both cohorts to participate in the market, the owner occupiers and investors. They both need to be competing for the same property for me to realize 10+% gains annually. So for something to turn into a hotspot, which would need to have 10+% annual growth, so between 10 to 30 or 40, you need both owner occupiers and investors fighting for the same assets. And if I'm investing in a town where one cohort is disadvantaged because of the holding cost, I'm impairing the purchasing patterns and the levels of demand that are assigned to property within that market. Same as bushfires. So when I talk about risk, I talk about economic, environmental risk. Now, I can't know whether the town will flood or whether it will experience a bushfire or whether there will be macroeconomic changes which will impact the industry in question. But what I'm doing is I'm buying myself an insurance policy.
Yep.
Essentially, I am going through a process of elimination, being able to sleep at night because property, like when you're using data, you're dealing in probability, not certainty. And if you're dealing in probability, you need to make sure that you're increasing the probability of a particular outcome. If you're increasing the probability of a particular outcome, you're going down the checklist to eliminate uncertainty. Okay?
Yep.
And if you're eliminating uncertainty, it will behoove you to actually make sure that it's not a centralized industry town, that it's not exposed to severe levels of flooding and bushfires. Now, there are ranges and grey areas there, but that's the second layer I put. The third layer I always address across every brief, and why we got these two towns, by the way, is affordability. So affordability will be one of the biggest drivers of purchasing patterns in the next forever if the economy doesn't change. And when I say economy, I mean because the difference between wage growth and property price growth has been the highest since 1970. I mean, I have a graph, the gap, and I can send it to you. You can show it to your listeners. The gap is astronomical, like it's huge, which means that, again, if it's sorry?
So I love that. I get the thesis behind it as well. But at the same time, can I present a counter argument to that?
Of course.
Where it's like, oh, that means that there's more wealth and the capital stock or the value stock in property is in Australia's assets is higher than ever, and most of that is dominated by real estate, where most household wealth sits. So the concentration of that is probably in the older generation, and that can get flowed through to the younger generation through pass downs and whatnot. So is that a fair
affordability needs to be contextual.
Yep.
It needs to be a ratio. And when you create a ratio, you need to have many different particulars in it. So first, it will be median wage.
Yes.
Then it would be repayments, how much you assign repayments towards repaying a home,
yes.
and LVR 80-20. Then it will be an interest rate plus a buffer.
Yep.
And when you include all of those, it's actually very contextual and specific.
Yes.
So then it tells me, okay, it's essentially a mortgage stress indicator. How much is an average household how long it will take an average household to pay off a property in a particular suburb?
Yes, love that.
So
you can compare now.
Yeah.
Compare now,
So and yes, if you look at, So to give you an example, let's say a suburb, when it comes to comparing suburbs, you can have a suburb that has a typical price of 600K and it takes 50 years average household within that suburb to pay off that loan.
Yes.
Or you can have a suburb that is the same price point, but it takes 18 years.
Yes.
So which one would you pick? You'll pick B. Why? Again, affordability index is very pertinent for the owner-occupier cohort. Because the owner-occupier cohort, for both, by the way, but let's begin with the owner-occupier cohort because we're talking about the affordability index specifically of a particular suburb.
Yes.
So what we usually see, the dynamics in purchasing is that usually any hotspot that's become a hotspot, it has started with owner-occupier purchases.
Yes.
So when you have a restricted supply, and I get into that, when you have restricted supply and very high levels of affordability for the general population of a suburb, small increases in demand lead to large material changes.
Yeah.
And this is when you see investors migrating to that market and you see the competition.
For sure.
So again, it is all a probability game. Of course, there are nuances within each market where, you know, some people are more wealthy, they can afford it, but even if you have wealth concentrated in real estate, the affordability plays a role because it talks to the serviceability aspect. If my median wage, let's say I made a lot of money, you know, let's say baby boomers have given me the property, my parents, you know, I have a lot of equity sitting on the sidelines. Well, how am I going to extract that equity if my median wage can't actually support the subsequent purchase within that same suburb?
Yes.
So it does actually play a role, and it's again, it's process of elimination.
Yes.
You know?
Can I lean into something, right? So going back to our listeners, the original intention was 600K, under 600K, equity extraction in 3 years. We took all of 10 seconds to narrow the entirety of Australia down to 4 suburbs, right?
Yeah.
We've now gone down to Emerald, there was Port Lincoln, there was a couple of other suburbs. So I'm looking at Port Lincoln and Emerald right now, and I'm thinking about everything that we've just talked about, the economic frameworks, all of that stuff that really is, to your words, increasing the probability that your property will get you to the goal that you want to have, right?
Yes.
I'm looking at Emerald here, right? Exactly the numbers that you said. Emerald has a affordability index as of 2025 of 18.
Wow.
Right?
Absolutely. And Earth out of 5 or thereabouts.
Earth out of 5.
Socioeconomics, we'll get to that, yeah.
Exactly. And then you have affordability index of the Port Lincolns of the world sitting at 35. So it's twice as expensive, effectively, twice as hard, effectively,
for internal residents to actually acquire property within that suburb.
So it's that layering, right? So when you are, if I can just take it back to the buyer's agent level, if a buyer's agent is presenting you a market and a property in a particular market, this is the kind of education that you need to have underpinning your understanding. Like, hey, yes, Port Lincoln and this, both hotspots, both have 20% increases, you know, both potentially get me to my goal. But like you always say in your masterminds, it's all about, it's relative, right? It's
correct. So to build on that,
yes.
Now Port Lincoln and Emerald might get you to your equity extraction time frame, but Port Lincoln has less steam.
Yes.
And if you're investing long term, you're going to get a friction point. By the way, if it increases in the next 3 years, which means that affordability index will increase and become less and less affordable, and it will hit a plateau. It will hit, which means that in the 10 years you hold the asset, you won't have 2 opportunities to extract equity, maybe only 1. Which means that holding Port Lincoln, hypothetically, you might have to reassess your folio at the 5 or 6 year mark to maybe sell the asset. But see, this is what people don't tell you at the beginning.
Correct.
They don't actually tell you, okay, there is, on the basis of these factors, there's X amount of steam left. I'll give you an example, Dallas and Melbourne.
Yes.
Okay. So there are certain cohorts that are speaking about Dallas all the time. Now, they just tell me that tells me they don't know what they're talking about, simply because, I have to say it, simply because Dallas might have, I don't know if you can pull it up.
Yeah, you can.
Yeah, so Dallas might have, and people are buying there, and you will see growth. But I think Dallas's affordability, it's very severely unaffordable for its residents. And it will hit, and then the question is, what is it, 50 or 40?
42 at a 500K price.
Correct, see? And there's so many people buying in Dallas. Now, you will see the growth in the next 2 years if you're a buyer's agent.
So everyone on Centrelink must be. Like, I don't understand. How does it take 42 years to buy
just to give you...
That's exactly what I mean. But that's why...
Can I give you some context? We pissed off probably 30,000 people yesterday by talking about the 3 worst suburbs in Australia and Victoria.
Yeah.
So I'm glad to have you on the team to piss off even more people. The residents of... There are
Artie's looking for
6,762 people in Dallas. They're like, where does that Mac guy live?
No. The thing is, I'm not pissing off the residents. I'm actually telling them, don't invest where you live. You know, buy somewhere else. Buy somewhere else.
Your house is shit.
Yeah. So
I'm the one that just said they're all on Centrelink.
Yeah. So it's and as you said before, I mean. Invest, or there's also a comparison. So first is the brief, and then when people tell me, what do you think about Dallas? I say, in comparison to what?
Yes. Oof. I can feel the passion. That's good.
You know, like it needs to be in comparison to what? Because nothing is intrinsically good and bad. You know, there's good and bad. Good is because the bad exists, and vice versa. It's the same with property, you know, like or with suburbs. A good suburb must be good because there's a shit suburb out there.
Yes.
So if you're asking me about one, I don't have the context of the springboard from which I can analyze, you know. So there's always must be comparative and 2 process steps. First is noise. You eliminate the noise. We talked about yields, you know. Let's say in the filtering, I would assign certain filters that must be present, which I was discussing. And then you go through a process of detailed comparison. Then you consider everything, the trends, the current values, for all of the metrics. And then you construct a picture that has a much higher probability of you achieving that outcome. So, yeah, I mean, Dallas is a good example about affordability. And then the last one would be, not for this price point though, for 600K, I wouldn't use socioeconomic simply because the market doesn't behave in the way that I would like it to. And what I mean by that is, socioeconomics plays a dominant role for price points at above 700K. And I think I've done research. There is 0.35% chance for an area with a typical price of 700K to double in value in 10 years with an ersatz of 1 and 2.
Wow. Okay.
With socioeconomics that are disadvantageous. So that socioeconomics play, and you know what, it makes sense if I reduce it to behavior. That socioeconomics play a phenomenal role at those higher price points. But when you're investing in lower price points, you know, 500K below, you're inadvertently bound to invest in areas that have lower socioeconomics.
Yes.
Because it's tied to the price point. And there are many areas within that price range that have grown 100% in a decade. Now, the question is, if they have, what is the steam factor? What is the affordability? How much does it have to go? And if it's gone to 500 with an ersatz of 1 or 2, that means that hypothetically it might have another 200K, aka Bunbury. Bunbury is a good example. Everyone was buying Bunbury, you know. It has an ersatz of 1 or 2, typical price of 750K, very unaffordable. How much steam do you believe it has? And people will say, okay, Matt, you know, where are you getting these rules in theory? Now, you know, social media has an internal memory, which is beautiful, you know, so it's great that he does. I really appreciate that. But, you know, it's when you analyze the behavior, and it's just a common sense. When I came to Australia in 2000s, I could fill up a shopping trolley with $20.
Yeah.
You know, now it takes me $3.50, you know,
Wow.
So that's a shopping trolley. Let alone imagine how the purchasing patterns and how you're going to reorganize your life if you do not have enough purchasing power and yet everything around you, including the property that you live in, is expensive. Do you think, and people don't understand, everything in nature is cyclical. I mean, it's a resistance band. You stretch a resistance band to a certain point where your physical constitution can hold, it will bounce back. It is the same thing with property, you know, it goes in cycles. Now, cycles take a longer time, but again, now, people will say, oh, you know, Bunbury, I made so much. This is the usual response that I get. The usual response that I get, I made so much money in Bunbury. Well done. I'm not talking about the fact that you made money in the last 4 years. What I'm talking about is how long you're going to be sitting on it now. You know, are you considering selling off, investing that money somewhere else? What is the steam, et cetera, et cetera. So that's why when I always talk about, I was talking about Perth as well, and the Perth cult used to attack me, and I don't have preferences either or, but I'm saying, when people say Perth is the best area to invest into, I always say, again, for who, for how long, at what rate?
For sure.
You know, how much steam does it have? Anyway, I'm digressing.
Matt, thank you so much for that. There's so many nuggets of wisdom there. In this episode, he's released quite a few areas that HtAG analysis has picked up as really, really good areas that you may want to start paying attention to. He's also picked out areas that you want to stay away from and told you why. So there's so many amazing lessons picked up in this episode. Matt, thank you very much. And we'll have you on again for another one.
Cheers, man. I appreciate it, really. Thank you for having me. I really enjoyed this. I was just getting heated up.
Loved it. Love the passion, man. Love the passion.
I love it.
Yeah.